Welcome to our webinar on the key deliverables from the Green and Social Bond Principles AGM 2020. My name is Nicholas Pfaff. I'm the Secretary of the GBP-SBB and the Head of Sustainable Finance at ICMA. It will be my pleasure to introduce and coordinate this event. We have near 900 virtual participants today from around the world. We hope that all of you are safe and well in these difficult times. I would also like to thank the Luxembourg Stock Exchange, and especially its Green Exchange, for its kind sponsorship of this event. A few points of housekeeping before we start. This event will feature 3 10-minute panel presentations, each followed by 20 minutes of Q&A from the audience. Each moderator will take questions through the Q&A function, which you should be able to see at the bottom center of your screen. As there are 3 different panels, please identify clearly which panel your questions are for. We encourage you to only send your questions during that panel to ensure they are seen by the appropriate moderator. For anyone who is dialed in audio only, please send any questions to greenbonds, in one word, at icmagroup.org. Delegates are in listen mode only, and only panelist videos will be shown. A recording of the presentation will be available after the event. Let me now turn to the substance of the event today. Next slide. On this slide, you will see an overview of our 2020 deliverables. We will especially focus on 3 topics: the update of the social bond principles, the release of the sustainability-linked bond principles, and the status of the discussions within our climate transition finance working group. Next slide, please. This is reflected in our agenda. After my introduction, the opening remarks of our CEO, Martin Scheck, and the welcome from the Luxembourg Green Exchange. At 1:45 p.m. UK time, we will have the panel on social bonds. At 2:15 p.m., we will go to the sustainability-linked bond principles panel. And then at 2:45 p.m., we will finish with the climate transition finance working group overview. At 3:15 p.m., we will close. I will now hand over to Martin Scheck, Chief Executive of ICMA. Over to you, Martin.
Thank you very much, Nick, and a warm welcome to everybody to this afternoon's webinar. As Nicholas has just mentioned, the aim is to update all of you on the key deliverables from the Green and Social Bond Principles AGM held earlier this month in a similar virtual format. And it's my pleasure to say a few brief words to open this afternoon's event and to set the scene. But before we start, I would also like to thank the Luxembourg Stock Exchange and Julie Becker in particular for their support, not just of this particular webinar, but also more generally in the context of developing the green and social bond markets where they play a leading role. I'd also like to recognize the work of the Executive Committee and the working groups of the Green and Social Bond Principles and congratulate them on what they've achieved this year. We're going to hear more from them during the course of this webinar. We're all still dealing with the consequences of the COVID-19 pandemic and the restrictions put in place, and it has changed the way that we live and work, and is likely to continue to do so in the future, even though some of the restrictions are now being lifted. As one would expect at the onset of the current crisis, most capital market participants, whether issuers, intermediaries, investors, or market infrastructures, focused almost entirely on keeping their employees safe and remaining operational, ensuring they had adequate liquidity and could operate remotely, with employees working at home, some in the office, and at their disaster recovery sites. And these measures, along with the widespread central bank support and a range of fiscal measures, enable the debt capital markets to function well throughout the crisis, despite some segments, particularly secondary markets, becoming stressed and at times illiquid. But directly relevant to all of us, a more enduring impact of the crisis has been the acceleration of growth in social and sustainability bonds, where we witnessed sharply increased issuance and demand. Perhaps this dreadful pandemic is an unfortunate catalyst for the growth of this sector, just as the launch of the GBP in 2014 and COP21 in 2015 were for the green bond market. Social and sustainability bonds are proving their relevance by helping to address the enormous social and economic issues emerging from and exacerbated by the pandemic. And I should mention that the framework which allows this market to flourish is defined by the social bond principles and the sustainability bond guidelines. And it was great to see the timely additional guidance provided by the GBP-SBP Executive Committee in March this year on appropriate use cases for social and sustainable bonds. And this has helped all types of issuers to come to market with bonds financing projects designed to mitigate the health and economic consequences of COVID-19. And as of now, social and sustainability bond issuance has doubled year on year, with a total year to date in excess of US dollars 45 billion. And it's also good to see that many of the major recovery plans to restore economic growth post-COVID-19 are linking sustainability inextricably into the recovery process. And this leads me to say more on innovation in sustainable finance. We've witnessed a narrative gradually shifting in our markets to issuers' overall sustainability strategy. And in that context, and preceded by developments in the loan markets that ICMA has also supported, you will have seen that the GBP-SBP published Sustainability-Linked Bond Principles, SLBP, at the AGM. Now, the SLBP are ambitious and they're designed to ensure a high level of transparency and integrity for a new market, which has great growth potential. They will help new players come to market, and I'm confident that sustainability-linked bonds will complement their use of proceeds brethren as opposed to competing with them. They're versatile instruments, and they can serve a wide universe of sustainability themes: climate change, green transition, social issues, governance standards, gender and diversity concerns, all contributing to the UN SDGs, and they're a major topic on today's agenda. At ICMA, sustainable finance is a strategic priority throughout the association. We're committed to the development of the green, social, and sustainability bond markets through our contribution as a secretariat to the principles, and to working with market participants and the official sector to ensure that the developing regulation is appropriately designed and implemented. In conclusion, I'd like again to thank the Luxembourg Stock Exchange for their support, and the members of the Executive Committee and the working groups of the GBP and SBP. I hope you find the information presented during this webinar interesting, and wish you a very productive afternoon. So thank you for listening, and let me hand over to Julie Becker, Deputy CEO of the Luxembourg Stock Exchange and founder of the Luxembourg Green Exchange, the LGX. Over to you, Julie.
Thank you very much, Martin. Ladies and gentlemen, supporters of sustainable finance, it is a great pleasure for me to open this event, which is dedicated to the recent publications by the Green Bond Principles and the Social Bond Principles. With these new developments, ICMA is set to guide the industry as we enter uncharted territory of sustainable finance. The Luxembourg Stock Exchange is proud to sponsor the event. We recognize and support the invaluable role that ICMA has played and will continue to play in driving the sustainable finance agenda. Through the publication of the sustainability-linked bond principles, ICMA has yet again demonstrated its unique ability to encourage experimentation, find market consensus around new products, and provide solutions that not only respond to market demands, but that shape future developments. This is the first time that ICMA provides a framework for a thematic bond that is not based on the use of proceeds. By diversifying the products on offer and opening our minds to different kinds of sustainability efforts that may apply to a broader range of issuers, ICMA marks the beginning of the transition decade. This new type of bond provides an opportunity for issuers to fund their transition and speed up their sustainability journey, all while providing legal certainty to investors. It is groundbreaking and necessary to strengthen and grow the sustainable finance market. Sustainable finance is about making a positive impact through financial investment, about contributing to sustainable development and the transition into a more inclusive economy. It's about societal prosperity and how to make it last. I'm happy to share with you that we are currently working to adapt the scope of the Luxembourg Green Exchange, or LGX, our platform entirely dedicated to sustainable finance instruments, to reflect these developments. We were eagerly waiting for a framework and a language which ICMA now has provided. Convergence of language and standards within the capital market industry is mandatory if we want to avoid market fragmentation. Exchanges should endorse best market practices issued by standard setters and absolutely avoid derogations and exceptions to ensure market integrity, consistency, and investor protection. Data is of paramount importance here. We need to provide complete, structured, and meaningful data to investors. They deserve the clearest guidance, the best disclosure, the easiest access to relevant data. Data that investors can fully understand and that allows them to compare different products. And exchanges play an essential role when it comes to providing access to this data. And we are committed to do our part through the creation of a data hub for bonds and funds. Let's look back at the past months. When the COVID-19 pandemic swept across the world, we saw an almost immediate uptick in social bond issuance. The S in ESG came to the fore. Multiple issuers turned to capital markets to fund their response to the crisis through social bonds. Since April, COVID-19 response bonds representing 19 billion US dollars have been listed in Luxembourg and displayed on LGX. As a direct contribution to the recovery efforts, LuxSC immediately decided to waive the entire listing fee for COVID-19 response bonds. I would like to take this opportunity to highlight ICMA's swift reaction to the COVID-19 crisis, and more specifically, for providing guidance to issuers in line with the SBP. And there is no doubt that this has helped many issuers over the past months. We have indeed a crucial time ahead of us, and we should not lose sight of the important goal laid out in the SDGs and the Paris Climate Agreement. We need to continue to work together to make finance part of the solution. The momentum is there. This is our chance, our responsibility, and our duty to make finance sustainable by default. Thank you.
Julie, many thanks for your kind words about ICMA and our role in support of the Green Bond Principles and Social Bond Principles and the great work that we'll be talking about today. I'm now going to introduce our first panel on social bonds. It is chaired and moderated by Lars Eberholm, who's Vice President, Head of Treasury and Sustainability at Nordic Investment Bank. And very importantly, he is also the chair of the Executive Committee of the Green Bond Principles and Social Bond Principles. Lars, over to you.
Thank you, Nicholas, and also a very warm welcome to everybody. Maybe I should say good morning, good afternoon, and good evening. I understand with 900 participants listening, there must be many people from various time zones, so a very warm welcome. It's a great pleasure for me to be moderating this first panel. This group is representing maybe it is actually our very best and most well-functioning working group within the within the social bond principles. The working group has again this year delivered a comprehensive package of relevant market guidance. And of course, the social bonds, as both Martin and also Luxembourg mentioned, Luxembourg Stock Exchange mentioned that the social bonds undeservedly became very relevant during this outbreak of the COVID-19 pandemic. And the group provided actually very swiftly new guidance, and also provided additional Q&A for that provided very good guidance for bond issuance during this period of time. I will present the panel, but before I do that, I really recommend everybody to add in questions so that we will be able to have a good dialogue with this distinguished panel. In the panel and the coordinators of the social bond working group, we have Denise Odara, and she is head of bond investor relations at the IFC. And we have Francisca Suarez. She is ESG analyst at Mirova. And we have Isabel Vic-Philippe, and she is head of Euro Aggregate at Amundi. And Denise, I'm quite sure you will start your opening. So over to you. Thank you.
Thank you very much, Lars, and for the wonderful compliment, and to the entire ICMA team and Luxembourg Stock Exchange for facilitating this platform. I'm Denise Odaro, Head of Investor Relations at IFC, and over the last 6 years, I've been actively involved in the Executive Committee of the Principles. A quick note about IFC, because there are 900 of you, and some of you may not know about IFC. We are a member of the World Bank Group, the largest development finance institution focused on the private sector. We are also an issuer of green and social bonds, but beyond that, we invest in social bonds, we provide technical assistance, advisory services, etc. So one of our mandates is growing the sustainable finance arena, and one of those, of course, is social bonds and green bonds. Over the last year, IFC, along with Mirova and Amundi, have led this working group, which has about 39 institutions. And for the benefit of those who like many, in fact, may be somewhat overwhelmed by the proliferating nomenclature in the sector, I would like to highlight that the social bond is similar to green bonds in that investors are only exposed to the credit risk of the issuer. So they're not exposed to the risks of a given project. In 2016, the working group drafted the initial social bond guidelines. And in 2017, we upgraded the guidelines to principles. Since then, the working group's objective has been to accelerate the development of the social bond market. Now, one of the evident impacts of the publication of the social bond principles has been the increase in issuance volume, and that correlated with the initial publication. But as a group, over the last year, our objective, as you see on the slide here, was to develop the social bond market infrastructure, review and refine the principles in line with market maturity. Through our annual consultation with members and observers of the principles, we arrived at a number of key deliverables, which over the next 2 slides, my co-leads will go over in detail with you. And so I'll now hand over to them and return to speak very briefly about the impact of COVID on our work. Thank you.
Thank you, Denise. So hello, everyone. My name is Francisca Suarez. And as Lars mentioned, I'm an ESG analyst at Mirova. For those who don't know Mirova, we are an investor that is specialized in sustainable investing. And particularly for fixed income, we are very much active in the green, social, and sustainability bond space. So over to the presentation as to what we delivered today. So one of the six deliverables that we provided today was an update of the social bond principles. This update includes a definition of social project, as well as an expansion of examples for project categories and target populations for further clarity as to what these mean. The second deliverable is an impact reporting framework guidance, which now includes more robust definitions of what output, outcome, and impacts are, and also reflects the update of the social bond principles, such as the expansion of target population. We've also provided in this document a working list of sample indicators and hope to update this in the future as well. So this is a this is a live document, as we like to say. Another of the deliverables that we provided was the update of the SDG mapping, where that now includes guidance where possible, where issuers can reference their methodology for alignment with the SDGs. Also, if applicable, to incorporate this in their external review process, and as well as encourage reporting on SDG aligned related indicators. And also we provided an annex with SDG related SDG related indicators for COVID-19 as well. So that is I will now pass on the mic, let's say, to Isabel, who will continue on with the list of deliverables that we provided this year.
Hi, everybody. I am Isabelle Vic-Philippe from Amundi. I am responsible for Amundi of Real Aggregate Strategies, and as such, I'm also in charge of the selection of social and green bonds for our green and social strategies. For those who doesn't know well Amundi, just to mention that currently Amundi is already managing over 300 billion euros investment following an ESG policy, and that we aim at having 100% of our AUM under an ESG policy by the end of 2021. So let's go to the deliverable number 4, which is the case studies. It's a collection of a framework already set up in the capital market. And so it's really a nice illustration of how issuers have applied the SBPs. And so it's really a practical and valuable way of helping issuers that want to come to the market, and also to give investors an idea of the type of disclosures they can expect. So what we have tried to do in those case studies is to have a representative set of all geography, type of issuers, sectors, and you will find it very useful, because you will have an idea of the use of proceeds collection, the SBP category of each project, the target population, if any, or the socio-economic outcome of the project. And also there's a linkage with SDGs, and also indicators that have been provided by the different issuers. Deliverable number 5 is additional elements on target population. So addition of a new target population. Also how to report on actual versus estimated impacts of the different projects. And then how to report on partially financed projects. In the Q&A, you will find also the definition of social issues and social outcomes. It's not that easy to differentiate sometimes. Deliverable number 6, it's the investor survey. So the aim of this deliverable is to provide an idea of what is the knowledge of investors on social bonds, to investigate on the potential and the current investor base, and also to give an idea of what are the investor expectations in terms of market development and reporting. And now I will pass on to Denise for a special section on the response to COVID-19 crisis.
Thank you, Isabel and Francesca, for that. I only have this one slide, but we all feel this is incredibly important. Everyone would agree, I imagine, that the onset of COVID has presented a paradigm shift, especially, as Juliet said, for the S in the ESG in the sustainable bond market. I said the other day that COVID-19 is akin to turning on the light at a party at an ungodly hour. We can now see the wreckage from revelry and imbibing from previous hours. Not in our lifetimes have we seen any such factor that brought the global economy to a near standstill. I mean, the effects of which have exacerbated underlying social issues and poor governance decisions. What we have here, albeit tragic, is also an opportunity to rebuild better. And the growth in social and sustainable bond issuance this year has shown that investors think the same. The social bond principles in their previous form were applicable to efforts addressing the COVID outbreak. But to further facilitate its interpretation, the working group provided additional advice for issuers in the form of a Q&A published in March on the ICMA website. And the Q&A ran the gamut from eligibility, as you can see on this list, to anticipated changes to an issuer's framework. In addition to the Q&A, the case studies of the first few COVID-19 related bonds were also published, alongside illustrative case studies created by IFC, in fact, to highlight use approach could be considered evaluating social bonds as a financing option for COVID-19 impact alleviation. Underpinning all of this is the fundamental prerequisite, and that is that social bonds related to COVID-19 or otherwise must follow the 4 core requirements of the social bond principles, which include the proceeds from these bonds must go exclusively towards addressing or mitigating social issues, wholly or partially, emanating from the outbreak. And the work that we did also in the social bond principles themselves under the project categories also went to illuminating this, I suppose, grey area as to whether in fact COVID could be covered by social bond principles. And we hope that you see from the results of what we've published that this is actually clearer to interpret, excuse me. Let me stop there and hand back to Lars. We only had 10 minutes and I hope that we did well on that. And we'll open up for Q&A. Over to you, Lars.
Thank you, Denise, and thank you for a very good presentation of the comprehensive package of deliveries. As you all can see, this is a very, very active working group and with strong deliveries. And let's go to the Q&A. And here I want to address. There's a question from the audience. I want to address investor. And that means, Francisca, I'm going to start with you. As an investor, you know, social bonds, typically the projects that you find there sits very close to governments and potentially also to IFC or, you know, MDBs. But as an investor, have you invested in a social bond issued by a private company?
Thank you, Lars. Yes, it is true that intrinsically you would think that social bonds can only be issued by MDBs, and I think it's the easiest link to do. But we have actually seen some social bonds come out from private companies, and we are invested in them. What is important is that these social projects be very much linked to the sustainability strategy of the companies. So there are certain companies that we can think of that have a very social link. So social housing is very often seen as a project. We also tend to see there's research and development that are linked to social related projects, particularly on health. So those are other kinds of social projects that we can see private companies come to market with. And obviously the list can go on so long as the imaginations of people are there.
Yeah, so you would say that social bonds is not only a government MDB topic, but it is actually relevant for the whole society. But what kind of feedback do you give to investors? You know, on the corporate side, can you give them some encouragement, or you know, how do you promote this? Because isn't that an important thing that we need to broaden this out, maybe to a broader audience than just the governments and the MDBs?
I do agree. So if you want to have a social bond market that is as robust as the green bond market, we definitely need more corporate issuers to provide diversity. And what I would do is I would highly encourage to corporate issuers that are willing or thinking about issuing green bond as social bonds, is to really go back to their strategy. What is their corporate strategy? How can they develop that into a more sustainable strategy? And also, what under those sustainable strategies can they identify that are actually social projects? So we see a lot, like I mentioned, R&D. So also we can also do a lot of investing at the project level when it comes to agriculture, for example. So having a fund or having having projects that are linked to helping smallholder farmers earn a living wage, and as well as, let's say, convert to organic could be something that could be a project. So it's really having the corporate really think internally as to what are the social projects that are very much linked to their sustainability strategy and overall corporate strategy. And also know that it doesn't necessarily only have to be a social bond. It can also have be a sustainability bond where you have green and social projects, because we've also seen that the capex needs for social projects are relatively small, and so some companies like to add that with green projects to make a green and social bond framework.
Thank you, Francesca. And now over to you, Isabel. There's a question here around the Amundi's very impressive targets of ESG asset under management. I think you have the target to be 100%, ESG compliant. And the question goes, you have built up a portfolio now of approximately 300 billion. Was that what you mentioned, Isabel? And then, what has it taken you to get that far? And how are you going to, achieve your goal to be 100% ESG compliant?
So for the time being, the number I mentioned is ESG is portfolios that are managed with an ESG policy. So it depends, of course, on our investor base. So institutions are at the forefront, but now we are seeing more and more demand coming from the retail side on that topic. So really, we are working hard to make it possible to have an ESG policy, a minimum level of ESG policy in all our funds by the end of 2021. And if we mention only thematic bonds, because we make a distinction between what is under an ESG policy and what is a thematic bond. So social bonds and green bonds are, for us, thematic bonds. And we have launched already some funds on the green axis. So we have green bond funds, and we intend to enter the social bond market with an open-ended social bond fund in the coming months. And then I agree with Francesca. We definitely need to have more issuances, so that at the end, the financial management of those funds can be as close as possible to what we provide for our normal conventional range. So ESG on one side and thematic funds on the other one.
Yeah.
And we see more and more demand coming from our investor base for those two types.
Yeah, clients that wants to be engaged. But what kind of communication do you provide to the market that, you know, because I think somewhat, you know, we need to guide the market and also give recommendations for how we can move. And if you have these very ambitious targets, I would assume they are not coming just by themselves. You also need to engage and try to you know, stimulate somehow.
Yes, we have an ESG team that has a lot of duties, and one of them is engagement at different levels with issuers, of course. At my personal level, I have met a lot of issuers on the green bond market prior to their issuance, to review their framework, to see what are their goals, to see what type of indicators they will provide. And so I would say we are an interconnection, being an investor between the different issuers, because we have seen a lot of them, so we know what is possible to deliver and what others have done. And so this is what we, at my small level, I have done to try to explain to newcomers what they can provide and what has been already done. And I think this is why what has been provided in the case studies by the SBP is very valuable, because you have an extensive collection of the different indicators, the different categories, and the different projects that have been already published and used by issuers.
So engagement, actually a typically owner instrument or an equity instrument, is also extremely important for the fixed income market. Yeah, very good point. Now, Denise, I'll turn to you. And here's a question. What is the changes or the main changes of the new social bond principle version, the 2020 version versus the 2018 version?
Sorry, I was speaking on mute. The changes, some of them have been covered by Francesca, of course, and Isabel. But in particular to the social projects, what we did was we expanded what we had there before. So for example, under employment generation, we've added programs designed to alleviate unemployment stemming from a socioeconomic crisis. The other thing that we did was we expanded under food security. We've added sustainable food systems and some examples of what that means. Lastly, under socioeconomic advancement and empowerment, we've done the same, where we are trying to make this readily and applicable to the corporate space, because as Francesca said, and as I mentioned earlier on, this is one of the key objectives of the working group, is to promote this product to the corporate world. So I urge whoever it was that asked that question to have a look at the new publication, and specifically if you're interested in how the projects changed. They haven't so much changed, it's been expanded in order to make the interpretation easier.
Thank you. And now, Nicholas, you may jump in if we are using our time. But maybe Denise, now I have you. What's on the table for the working group for the coming season? That's another question we get.
Is that directed to me, or who was that directed?
Yeah, to you.
Okay.
To you.
So, I mean, we this year did just phenomenal amount of work, and the first thing I want to do is thank every institution. As I said, there are about 40 institutions that are in this group. I think over the next year, just given how much growth we've seen in this product, it would be remiss of us not to continue this same momentum. And so what that means is making sure that the principles remain in line with, market momentum, market developments, etc. I think the other side of it really is, as we start to see some sovereign issuance, and which is always a quandary of mine, because people often say, well, this social should be more sovereign or government. And I think there's one of the questions in the chat box that alludes to this. But of course, we haven't seen that much as yet. I hope that that will come to the fore more so than we have seen it, and particularly, again, in the corporate space. Over the next year for the working group, there's a lot more that we're going to do. The work on the SDG mapping, we hear repeatedly from investors that this is a key area of focus for them. So we will continue to work on that. And again, on impact reporting, which everyone mentions is the bane of their existence when they're working on, the annual impact reports, is twofold. How do we convey impact, but also in a concise manner for investors who are investing in so many bonds in one portfolio and need to obviously take concise information to the stakeholders. I think the flip of that, we've also seen that some issuers who came to market, and Lars, maybe you want to talk about NIB's issuance in fact, but for IFC, for our social bond, which was done on the back of our announcement of IFC's response to the COVID-19 crisis, we did not change our framework because, as I'd said, the social bond principles in this previous format was in fact applicable to the outbreak. However, some issuers have taken that extra step of amending their framework, etc. And we get a lot of questions about framework and reporting. I want to stress that, be it COVID-19, social bond, or whatever other label that the bonds have, so long as underneath the bonnet it should have those 4 core requirements in order for it to be a credible bond for the investors, like as we have Morova and Amundi hopefully will back this up, and I'm sure they will, that these are what you need to do to have a credible social bond.
Thank you, Denise. Very good. Let me just see. I had a question here. And again, Nicholas, you may jump in if we have used our time.
I think we're good. Lars, I think we're good for 2 more questions.
Very good. Then I want to turn to Franziska. The EU taxonomy was approved yesterday successfully and very good. They have the terminology do no significant harm, and that of course also relates to any social issues. Have you had that discussion in relation to social and the social bond principles, and where can I as an issuer find guidance on this?
With regard to do no significant harm, we have had that discussion. So for example, what we get, well, was a very overbroad, a very general example, but develop employment, so employment retention or employment growth. But then at the same time, the company where this employment retention or employment growth would be, the main projects, the main activities are contrary to 2-degree scenario, for example. And in that case, then there is always that exclusion of what industries would we not invest in, regardless. So tobacco industry, I think, is a very good example. Whether that be green or social, it will not be, because of the do no significant harm, at least from Morova's point of view, it would be a very difficult industry to come out with a green and social bond. But with regards to what the guidance is, I would highly suggest checking out the Q&A. So Denise mentioned that we had extended Q&A for COVID, but also there's a Q&A for general questions like this one. I don't have on the top of my head the specific question, but I would not be surprised if it's not already addressed in the Q&A for social bonds.
Yeah. Thank you, Franziska. Very good. Then we had also questions. I think one question came in written format before the call, but also now I can see there's a question around impact reporting and potentially also post-issuance reporting and requirements. And maybe Denise, if you can, if you can just briefly touch upon this, what are the recommendations and what potentially what are the IFC doing regarding post-issuance reporting?
Thank you, Lars. The principles, both for the green and social bonds, are similar in this stance, which is that issuers are expected to report on an annual basis up until at least full allocation, and thereafter an event of material development. Quantitative performance indicators are encouraged as well. At IFC, we certainly have an annual impact report for both programs. I think one of the things that I'd highlight, and I'd also hand over to Isabel to speak about, and the work that we did on the impact reporting harmonized framework. So similar to what has happened on the green side, we've worked on Annex A of that document now has a long list of sample indicators which differ according to industry. And so the key thing is that investors expect for you to report, the principals expect for you to report, and this should be done at least on an annual basis, and in the case of where there are material developments, as and when that occurs. Let me stop there and see if Isabel and Francesca want to add to that, because I always think it's interesting to also hear from investors what they do with these reports that take us, at least at IFC, I will say that our impact report process takes at least 3 to 6 months of putting together. And so this is, it's certainly done with a lot of joy and elbow grease, but I love to hear from investors what you do with it, and I think the audience will benefit from that too.
And Isabel, could I then add also, these social impacts seems to be, the impact could materialize over a very long time. How do we actually, manage these things in relation to your communication with stakeholders and clients?
So green bond and social bond, they are, it's all about transparency. So we need to give to our end investors all the transparency we get from the issuer. And so this is what we do on a monthly basis. We provide a reporting that is really dedicated to those thematics and give a lot of elements on how the proceeds are used, and also in terms of impact, if it's possible. So it's easier for the green, it's much more difficult because it's much more granular for social. What are the impact of their investment? So for them, it's very valuable to have those type of indicators and those transparency on how the funds are used. So for us, it's key.
Yeah.
We may need to transition here. I don't know if Francesca wants to add, but we may need to transition.
Yeah, one comment from you, Francesca, regarding impact reporting.
Thank you. I think I would just echo actually what Isabel mentioned, that for us, our end investors, so those who are invested in our funds, really ask a lot of questions about what is being invested in the social, green, and sustainability bonds that we're invested in. So transparency is definitely key, and impact reporting as well. So nothing to say. Thank you.
And we are going to conclude here, and thank you so much for all the very good questions. But first and foremost, thank you very much to Denise, Francesca, and Isabel. Thank you so much for your key deliveries and your contributions, and thank you for participating in this very brief and short panel. Thank you. Bye.
Thank you very much.
Echoing Lars, many thanks to the panel. And I'm now going to introduce our next panel, which is on the very important topic of sustainability-linked bond principles. The panel will be moderated by Tanguy Claquin, who's the Global Head of Sustainable Banking at Crédit Agricole CIB. But very importantly, he's also the Vice Chair of the Executive Committee of the Green Bond Principles and Social Bond Principles. Over to you, Tanguy.
Thank you very much, Nicolas. So good afternoon, good morning to everyone. My name is Tanguy Claquin, so I'm Global Head of Sustainable Finance at Crédit Agricole CIB, and happy to talk with you all today. So I'm going to be quickly presenting the work that we have done with the work group and the coordinators, and then ask questions to the various speakers. So following two benchmark public transactions that were done last year, that were SDG linked on the one side, and by NL, that some of you have noticed, where there was no use of proceed, but the coupon of the bond could vary depending on the achievement of some environmental related objective. And following the very strong development that we have seen on the loan market with a similar instrument, Green Bond Principle decided at the end of last year to create a task force and then a working group on sustainability linked bond with a view to work on designing best practice for the market. So we created this working group that was coordinated by Marvin Cheshi from JP Morgan, as well as from Natixis, and Christopher Fransborg and Gabriela Eriksson from SEB. And we were joined by a very, very large number of ExCom members and observers who work on those best practices, which we finally managed to transform into principle just for the AGM. Briefly, next slide, please. Those principles that we published are based on 5 principles, so that's a bit different from one principle. Those 5 principles are summarized in the following slides. The idea of a sustainability linked bond is a transaction which is a forward-looking product where the characteristics, financial structural characteristics of the bond can vary depending on the fact that a KPI will reach it. So the first principle of sustainability linked bonds is that there should be KPIs. KPIs should be relevant, core, and to the issuer of all business, and should be of high strategic significance to the issuer. It should be obviously measurable and quantifiable, externally verifiable, and benchmarkable. So a usual KPI would be, for instance, the carbon emission of a company. If you ask yourself, what is a KPI? An example of a KPI is carbon of a company. So that's the first one, and you can obviously have one or more KPIs. So, but the idea is just to work for the beginning with just one KPI to describe the product. Next slide, please. The second principle is that on this KPI, the issuer should calibrate a target, what we call sustainability performance target. So a target. So if you keep the same KPI of the carbon footprint of a company, this target could be, for instance, reducing the footprint by 20%, or achieving net zero in a given date. So the target should be ambitious, which is a word in which we have debated a lot. This ambition means that it should represent a material improvement in the issuer business, a material improvement of the KPI. And in order to be able to assess this materiality, if this target should be, if possible, or where possible, compared to a benchmark, and consistent with the issuer of all strategy. Of course, this target should be set at a predefined timeline, one date or a number of dates during the lifetime of the transaction. And in order for issuer to have capacity to assess the quality of this benchmark, in fact, not only this target should be compared to issuer own performance, but also potentially to its peers and to scientific reference when available. And of course, the principle that we have put on the table recommend, if possible, to have an external review on this, the estimation of this ambition. Next slide, please. Now, the core element of the sustainability linked bond principle is, of course, the fact that if the KPI reaches or doesn't reach the target, then there should be a change in the bond financial or structural characteristics. The most common example that we have seen in the market is the change in the coupon that we've seen in the case of the NL SDG linked bond. There may be other possibilities, and on purpose, the working group has decided to leave this point relatively open for the market to be able to design tailor-made transaction that would fit with the issuer and investor needs in that space. Nevertheless, in fact, there should be an impact on the bond financial and structural characteristic. And of course, this impact should be commensurate and meaningful relative to the original bond financial characteristic. Those are guidelines. We think those are fair guidelines with what the market is expecting, and given the feedback that we have received, we think those are fair guidelines, and they leave still a large room for market development. Next slide, please. The two last principles are, of course, also very important. Similarly to the green bond principles mentioned before, this product is also relying a lot on accountability and transparency. So one of the key principles is the reporting on the performance of the KPI that should be disclosed on an annual basis to the investors and should be made public so that the investor can monitor how the KPI is developing over time and how it could impact the bond characteristics. So it should be published regularly, and the last principle is the verification. We have made it. So next slide, please. We have made it a principle because maybe more, and certainly more than in the green bond principle and in the social principle, the fact that the KPI may have a strong impact on the bond financial and structural characteristics. In fact, this is absolutely necessary that the KPI, and especially on the target dates where there is an observation of the target of an objective, this KPI should be verified externally, so, and independently from the issuer. So the fifth principle, we thought it was very important to make it a separate one. The importance of this verification in the overall dynamic of this instrument. So that's the 5 principles that we have put together. We think that they are adapted to what we try to achieve with this instrument that, in fact, as you know, has attracted a very strong interest from many market participants because of this capacity to be used by a wide array of issuers and to widen the spectrum of sustainable finance beyond what is already done in green and social bond market. And so I just want, before then turning to my fellow coordinators, want to thank all the working group members. I think the history of the green bond principle, this is probably the widest working groups in terms of contributions, and we had more than several hundreds of contributions coming to the first draft of the sustainability bond principle. So thank you all for your strong commitment and for the input you've given that enabled us to put together these guidelines that we hope are quite helpful for the market to develop. But now I will turn to, as I say, to my local coordinators, and maybe turn to you first, Oreth, and asking you the question. I mean, we have put together this principle. There was already the sustainability-linked loan principle existing in the market. Can you maybe underline what are for you the key new points that we have added to this in this text, and for you that could help the market strive?
Thank you, Tanguy. I guess the main difference is a structural one, which is sustainability-linked bonds are aimed to be market instruments open to all investors, and not instruments between a limited number of parties, meaning that the transparency and the level of explanation that is embedded in these principles are up to the challenge of addressing simultaneously all type of investors with all types of skills to actually and technical skills to actually understand the KPIs that would be embedded in those type of instruments. So I think the main difference is the fact that we're addressing the market as opposed to solely being a, let's say, private party club, which is what we have seen on the loan market. On the top of that, we have managed to bring the we have tried to manage to bring the SLBP one step further in terms of granularity of what we have said with regards to the ambition required in these instruments, and the way it needs to be legitimized and elaborated by the issuers ahead of issuance. I guess it's another aspect. So you, as you have seen within the principles, we went into quite great details into how each KPI needs to be selected, and how the targets need to be justified. So I guess those would be the two main differences I would point with regards to the SLL market.
Thank you very much, Orith. Maybe another question then to you, Christopher. I mean, what is your expectation for the development of this instrument? How do you think it can change sustainable finance in bond market?
So from our side, we think that there's a huge potential into this market. So there's a number of features which was not existing in the green bond market. So we think it's going to be a very, very important supplement. One area where we think it's going to have a high importance, that is in companies which are not really where they want to be, but where they have been putting down the foot and saying they are going into a strong transition, and where investors might be uncertain about the direction and need to have some kind of firm commitment where they basically come out and say, in case that you actually achieve these kind of goals, we're actually going to pay, we're going to pay you for achieving those, because that's going to reduce our overall risk, meaning that there's going to be some kind of a link to our financial performance, allowing the investors to say that the investment is done on a commercial basis here and now, but if they're going to change the overall kind of ESG strategy, the risk parameters are going to be improved, and consequently the risk return is going to be improved as well, meaning that they're willing to pay actually or receive a lower yield than it would be otherwise, meaning that this is opening the doors for a whole new group of companies to join the sustainability fixed income market as one part. The second part, one of the most important thing with the principles, these new principles, is that we once again confirm that you can actually create some kind of a harmonized language across products, across different kind of topics, themes, or whatever you want to call it, in sustainability markets. And we think this is not only in respect to sustainable bonds or social bonds or green bonds, but it's also on loans, and it's also on equities, basically meaning that we're suddenly getting a language under which we can create a common due diligence process, allowing everybody to follow the same kind of a pattern when they're creating sustainable financial products. And we think that is very, very important. It's also important that the 48 supporters, that the ICMA as the host, as the secretariat for the principles, and also we as the coordinators are capable of coming out quite early and saying that this is possible and this is the way we should create these kind of products. So we are very, very happy with the principles.
Thank you very much, Chris. Last question, maybe before I turn to the Q&A that I'm seeing popping up in the chat, to Marilyn. So Marilyn, we were together, one of the 4 banks drafting the green bond principles several years ago, and there were 4 banks. Without Zoom was not existing at the time, and now we have drafted this tech with several hundreds of participants from different institutions, different industry. The diversity of the stakeholders has been huge. How do you see that? I mean, as a long-standing player in this market, do you see this diversity as a fantastic increase in the quality of what we're doing, or do you see it as losing with what we're doing, or do you see it as a complement?
So I thank you for that question. I definitely see it as a compliment. I think that you know, when we first came up with the original draft, it was with a tremendous amount of input from our working group. And there's a tremendous power in allowing for that and encouraging that. When we think about the original draft of this particular document we put together, the input that we received, encouraging us to include a 3-year history of each of the KPIs, along with a forward look for the SPT, you know, and how the issuer will incorporate that, was actually very important, including above business as usual, right? All of these concepts were reinforced by the diverse membership of the working group. And I think that was actually quite helpful in the creation of this.
Thank you, Marilyn. So I'm turning now to question that we receive on the chat, and I will stay with you, Marilyn. I mean, there's a first question related to the structural characteristic of the bond. What could be the change in structural characteristic of the SLB?
So it's a good question. We were not prescriptive intentionally when we drafted these principles because we want to allow for innovation. Certainly, the tenor of the bond could, in theory, change, right? You could have anything other than the coupon. The coupon is one of the most obvious and easy to envision, but you could, in theory, make the bond callable or puttable. I mean, there are other structural characteristics that you could think of, but we intentionally did not put that and describe that within the principles because we want to allow for innovation going forward.
Thank you very much, Marin. We have other questions related to, to the choice of API. Maybe I will turn to you, Orith. There's a question related to ESG rating. Can ESG rating be a KPI for SLB?
This is a good question. Yeah, can you hear me? Yeah, can you hear me?
Yeah.
Can you hear me now? Yeah, sorry.
Yeah.
We have made the decision based on many inputs we had on the way not to outrule the use of ESG rating as a KPI because a number of participants were working group member participants were keen to make sure that option was open. Having said that, the ability of ESG ratings to match all the criteria that we have set, as especially with regards to the benchmarkability of those ratings, is making it quite challenging to use them, but probably will more and more in the future as ESG rating evolve and probably as ESG rating get framed by the regulators. So the answer to your question is yes, it's technically possible, but the ability of ticking all the boxes expected by ESG rating is probably a bit challenging.
Thank you, Orith. Christopher, we also have question about a word that we have debated during hours together. So a material improvement. So the material improvement, how can we assess that? And a bit related to that, there's a question saying, do you think that a company would engage into such a transaction if there is a risk that they don't meet the KPI? So how do you judge that the target corresponds to a material improvement? And do you think that a company would do a trade like this if there's a real risk that they don't reach the target?
So first of all, I think there would be a number of different views. It's a challenging question, right? And I think it was highlighted in the previous session that one of the most important sectors or features of any of the principles is transparency, and I think that transparency is allowing investors to judge with their money, and the market to judge with their money, and I think that it will be quite a risk for anyone to go out with a commitment they can't follow, meaning that there's not going to be very clear goals, there's going to be very clear KPIs on the way, and there's going to be a high degree of disclosure, transparency into this, which is allowing you can say a monetary communication or pricing communication between the issuer and the investor, and this is followed quite heavily. We're coming into this to the verification as well, and since that there's a financial element into the performance, there's a need to have some audit in respect to actually getting the verification of the numbers are accurate. So this kind of a balance between the transparency, the auditing on material numbers, the link into the financial performance is allowing dynamic of the bond market to develop. And I think that many of the principles, many of the issuances we're seeing out there are basically built on the old principles of capital markets, which is basically trust. And we are now trying to create guidelines to create transparency, which is allowing trust to be built. And obviously there will be cases where goals will not be met, and where there needs to be disclosure around that, and where the issue will be challenged in respect to how to communicate that to their investors. And in case they're not capable of doing that, it's gonna be seen as undermining the trust, and they will be paying for that in pricing. So I think these kind of dynamics are extremely important, and we've been trying in the principles to kind of assure that there's a certain kind of due diligence process, and there is disclosure, and there is an auditing which is allowing the trust to be built, and then when it's not being met, it's up to the communication from the issuer to assure that they can explain why it's not being met, and how they're going to basically to meet the lack of the missing expectations from investors. So I think it's a complex question, but I think that the principles are giving good guidelines with respect to how to structure the framework so you can build the trust over time.
Thank you, Christophe. Looking at the list of questions, we have a number of questions regarding the external reviews, and so explaining again how it works in the principle, what is recommended, what is mandatory, who can provide those reviews, potentially what is the cost, what are the legal implications if there is no review. Maybe Orith, you want to take this one to just make another summary of what we expect in terms of review in the SLBP?
Sure. So what we've put, so what's very, I guess, a bit different from what we had on the GBP SBP is that one of the core component of the SLBP is what we've called verification, which is an ex post verification of the performance against the KPIs on each KPI and against the SBTs, which we expect to be a necessary component of the SLBs. So that's really is a verification of the data themselves. What we have said in terms of ex ante external review is without putting it as a necessary element, we have recommended the use of an external review in the type or in the same sense of second party opinion that we're very well now used to in the green and social bond markets, whose mandate would be to verify the compliance with the SLBPs, but more specifically opine on the choice of the KPI and the ambition of the SPTs, or at least the consistency of those targets with the strategic positioning and the strategic planning of the issuer. So those are the two external reviews that are embedded into the SLBPs.
Thank you very much, Orith. Marilyn, there are questions, the classical one, I would say, which is the competition with the green market. Do you think that this instrument will replace green bonds somehow? Is it the goal? And second thing, maybe a more technical one or specific one is, do you think that SLBP can apply to project finance? And if it's the case, where should be the KPIs, at the project level or at the sponsor level? Maybe we can take those two questions.
Yeah, thank you. So first of all, I think it's very important that everybody understand that the SLBP was not intended in any way to replace the green bond market. I think it is absolutely our vision to see it as complementary to the green bond market. We know that the green bond market is heavily weighted towards property or REITs, the utilities, as well as rail. They have tons of CapEx, which makes the use of proceeds instrument very relevant for those industries. What we are lacking are those issuers that are CapEx light, those that don't have a tremendous amount. So the corporate market will be likely to look to the sustainability-linked bond market as a useful tool in their toolbox. You know, NL, of course, has already issued green bonds, and they've, of course, been the leader in issuing the sustainability-linked bond. So we don't see them as mutually exclusive in any way, shape, or form. You asked about project finance. Interesting question. You know, one of the things when we think about, as Oreth has highlighted, some of the differences between the sustainability-linked loan market and the bond market is, of course, we've added some additional, shall we say, disclosure requirements and other high-level details about how the KPIs and SBTs relate to the issuer's overarching strategies. So if you're asking whether we focus on the project itself or the sponsor, right, of the project, I think it's important that both are included in this. The risk, of course, in project finance is to the project itself. So the emphasis of the KPI and SPT should relate to the project itself, but I don't think you can 100% dismiss who the sponsor is. I think it should be part of the overarching narrative that we bring to the table.
Tanguy,
maybe I can just add in here, Tanguy.
One more question, apologies. Sorry, Christopher.
I will take the last question.
Maybe I can just add in here. Thank you. Maybe I can just add. Is it okay if I just add in on Marilyn's here?
Okay, go on, Christopher.
Thank you.
Yeah, sure. I had another question for you, but
yeah, no, but I think this is important because I think there's one more factor, and there's a couple of issues coming in here as well in respect to how to navigate on the pricing where you have opposite interest, and also in respect to not only green bond, also transition bond, whatever this is a replacement. I think it's very important to keep in mind that the sustainable linked bonds is actually having a trigger event, which is financial, linked into an ESG link. And that means that the players, investors, issuers, as well as the intermediaries, the banks, pricing vehicles, need to be capable of understanding that link. And that means that there's a possibility that this instrument will be a little bit less liquid and a little bit more difficult to put into mainstream portfolios than others, because the stakeholders need to understand the KPI links. And that means that it's not replacing the transition bonds, it's not replacing the green bonds. It is, as Marilyn said, a complementary issue. And I think that it needs to be seen and understood that way. Sorry.
Thank you, Christopher. I think Nick, we have a number of questions, so don't hesitate to reach out to us if you have any other point that is not clear. And with that, Nicolas, I hand over to you.
Thank you very much, Tanguy, and thank you to Oreth, Marilyn, and Christopher for a fascinating panel. We're now going to move to the third and final panel on climate transition finance, and I have the pleasure over to Joanna Kobe, who is the head of responsible investment at Zurich Insurance. But again, very importantly for this session, she is the ExCom Vice Chair, so Executive Committee of the GBP SPB Vice Chair. Joanna, over to you.
Perfect. Thank you very much, Nicolas, and also from my side, welcome. Good evening, good afternoon, and good morning to everyone who is still on the line. The wonderful thing about being the last panel is we're very grateful you're still here, and also the topic has already come up a couple of times, so we can really pick up that reference. With me today, I have three panelists. I have Fana Bigoli, who's head of sustainable bonds EMEA for HSBC. I have Paul O'Connor, who's head of EMEA ESG debt capital markets of JP Morgan, and Nyo Takasuki, head of ESG research and active ownership for AXA Investment Management. So those three panelists that you will hear are the sitting co-chairs of the Climate Transition Finance Working Group. It might be interesting for you to know, in terms of context, that this is one of the younger working groups that we have. It has been established by the GBP SBP Executive Committee only in the beginning of this year. And we've really set it up in order to explore a variety of questions. This working group was set up in order to be instrument neutral, but topic specific, and specifically to look into what the climate change transition means in the context of the green bond principle market. You remember at the beginning of the year, of course, traditionally the GBP, SBP and sustainability bond guidelines are all use of proceed instruments. So that is our joint background, our joint knowledge. But we were really wondering about the topic of transition finance and climate change transition that had come up more and more in the market. So we asked the working group in the terms of reference to set out to answer two questions. One, in the European markets, we look very much at projects, of course, but climate change transition is something much bigger than projects, and they usually need to fit into a strategy. So we looked at the importance of the issuer's climate strategy and financing and how that should be defined, how it should be reflected in the market, and specifically what market participants think about it. And secondly, we noted that, of course, in climate change transition, key players are not only those industries that are already green today, but also hard to abate sectors that need to move and become greener as they transition. And we noticed that they're broadly missing from the green bond market as we knew them. So we also asked the working group to find out why that might be and what those sector participants have to tell us. So the three distinguished panelists with me here today have volunteered to co-chair this working group, has started up work in January with actually quite a big working group. And I will hand over to Farnam to take us through a presentation of what has happened since January. Farnam, over to you.
Super, thank you so much, Joanna. So as Joanna said, we are one of the youngest working groups. We were formed in January of this year, and to date over 80 institutions globally have joined, and a great combination of different stakeholders across this market, and about 25% of our members are actually not members of the GBP itself. So we've reached out in order to get the perspectives of the broader market on this very important topic. When we launched in January, and John has given a very good overview of the terms of reference, so our key tasks were to look at the problems of industry diversification, as well as the question of issuers' climate strategy and financing in the context of the green bond market. The first thing we did was to actually launch a corporate consultation to survey the perspectives of corporate issuers regarding the issuance of green bonds. And really the purpose here was to assess why corporate issuers from different industries have been largely absent from the green bond market, and to look at the reasons for that and what guidance might be needed. We followed up this work. This consultation was ongoing for the majority of the spring. We followed this up with an in-person working session in February in London, which over 50 participants were able to join. And there were representatives here from issuers, investors, investment banks, exchanges, climate specialists, research and industry groups, global representation from Japan, Canada, and Australia. And the goal was, again, on the second part of our terms of reference, which is on the industry diversification, the climate strategy and financing piece. So those of you who are familiar with the green bond principles will recall that Pillar 2 does make reference to the consistency between a corporate strategy and the green bond use of proceeds. So in this meeting in February, we were thinking about that specifically with regards to what a well thought out climate transition strategy would look like, and how that consistency between the strategy and corporate expenditures could be assessed or evidenced for the purposes of climate transition finance. And we were very lucky in the context of that meeting to have representation from the Institutional Investors Group for Climate Change, Climate Action 100, the Transition Pathway Initiative, the Science Based Targets Initiative, and the Canadian Panel on Sustainable Finance. Some of the key global stakeholders when it comes to thinking about how climate transition strategies should be evidenced. And the key focus of the discussion was, again, what that means from the issuer level perspective, the application of the Green Bond Principles second pillar, and also the relevant transition pathways. We have put out a discussion paper. I will get into some of the key conclusions of that shortly, but there's also a fuller discussion paper on that meeting available on the ICMA website. In April, we launched a broader market consultation to get consensus on the key points of contention, basically, on the working group's work. And these were three major questions. One was the scope of expenditures and the type of instrument that could be labeled as climate transition finance. The second was the application of the green bond label to hard to abate sectors, particularly where transition strategies were undefined. And finally, on the requirements and recommendations on the level of disclosure for issuer level transition strategy for climate transition finance. This consultation saw a great response. I'll summarize the perspectives shortly, but we were very pleased to have over 110 participants in that consultation, which has fed into a draft document that we are producing that is summarizing working group and market participant views on climate transition finance. That document is in the works right now. And the final kind of piece of our work for the 2019-2020 year is going to be a guidance note on best practices in climate transition finance and the development of our working plan for next year. Can you go to the next slide, please? So just to give a perspective on the key takeaways from that in-person meeting that we had in February. And I think one point of reference here, as I mentioned, we did have participation from a number of institutions, but we basically had four major questions that we had asked everyone to look at. One was around how issuers should evidence their commitment to the objectives of climate transition. And here, I think there was widespread consensus that transition is about how companies seek to contribute to achieving the goals of the Paris Agreement. And one point of detail that came out of this was that issuers should be expected to set a long-term strategy and objective that's in alignment with the Paris Agreement, and should evidence it through continuous disclosure on strategy and governance. The question of the sort of framework for that disclosure was another key question that we raised. And here we were asking participants whether the TCFD is a sufficient framework to describe climate-related risk management for all issuers, and whether that should be the base expectation for any issuers of climate transition debt instruments. And here we found that respondents and members of the consultation really agreed that it is an important framework, but there are some challenges around full alignment to the TCFD, but very much where possible, issuers should commit to it. We finally asked around 1.5 degree alignment. So the question of what to do here with regards to industries that are not fully aligned and may not be fully aligned within the immediate future, how can they be expected to describe whether their strategies are business as usual or really shifting their business towards achieving the Paris goals. And here, the key takeaway from the in-person meeting was that the credibility of an issuer's climate strategy is really around science-based targets and setting sector-specific transition pathways. That scenario analysis may be challenging, especially where we don't have technology, but where possible, issuers should try to align to this. And finally, on the last key question of the in-person meeting, which was around climate finance transition instruments, how really you can link a financial market instrument to a broader strategy. The findings of our in-person meeting was that the use of proceeds could be broader than just CapEx and should be more focused on how corporate expenditures of varying types are supporting the successful implementation of strategy. Next slide, please. So as I mentioned, I think there were some key points that we wanted to tease out where we felt that within the discussions, there was still some points of contention, and we wanted the perspective of the broader market on these key points. One was around the relevance of existing guidelines to identify companies that are ambitious about decarbonization within their industry and market. And here we really asked two questions. One was around whether the GBP in and of itself was sufficient, and the second was whether regional guidelines, including the EU taxonomy and green bond standard, were seen to be sufficient. And I think there was a varying view from the market on this, but what was pretty consistent was that because a lot of these regional standards and the green bond principles do not specify the requirements of an issuer's sustainability or climate strategy and targets, there is something missing when investors and other stakeholders are trying to assess their credibility. We also got better clarity on which elements of an issuer level strategy should accompany debt finance for climate transition. Basically, what should be a requirement or a strong recommendation rather than a best practice. And here there were key points of unanimity that came out. One was around disclosure on governance arrangements to oversee transition strategy, here specifying that it should be board or senior level representation. The second was on the transition pathway and the levers towards decarbonization. The third was on emission reduction targets in scope 1 and 2. Fourth was the long-term target to align to the goals of the Paris Agreement. And finally, an external review from an independent expert. But our market consultation was much broader than this, and there have been some really interesting findings. And as I said, the key deliverable that will be coming out in the coming months will be a guidance document that summarizes them in more detail. I'll pause there and we can maybe jump to questions.
Excellent. Thank you very much, Varnam, for that summary. And I think at that point, I'd really like to congratulate the working group coordinators, because 80 participants is not easy to manage from a project management point of view. And I think it really shows we have a lot of knowledge in the green and social bond principles member and observer basis. We try to set working groups up to be really inclusive, but you three went beyond that to really make sure that organizations that aren't yet observers of the GBP SPP, they might become some, we might want to them, but to make sure that they're at the table and really bring in their knowledge to drive this discussion. So, thanks for that. I think that's great and a very good summary. And of course, it also opens an entire amount of questions. So maybe I'd like to start with, we did set up that working group in the executive committee because transition finance was a discussion that really came up in the sector, specifically noting that transition is needed in hard to abate sectors, that they're missing because a lot of green bond market participants didn't really want them because they were perceived as green enough and potentially greenwashing. The other idea then that came up is that, giving them an opportunity to move from brown to a bit less brown, and that is what transition finance revolved around, or at least the idea and discussion for a bit. Now you consulted the entire market, which includes research, but a lot of investors, issuers, and the resounding answer was a couple of steps forward really aren't enough. If you call it transition, climate change transition, it has to be Paris aligned, it has to be 1.5 degree aligned. That's full Monty, which is a resounding feedback. What do you take from that? Was it surprising to you? And what do you think how that answer really influences that discussion and debate going forward?
As someone who look at both the equity side, so through our active ownership dialogue with companies on a bilateral basis, we obviously run a program of one-to-one engagements with companies across different industries, but also participating in industry working groups such as Climate Action 100+, which was mentioned. The big discussion topic over the last few years has really been about that credibility of the future plans at the company level. So it wasn't just a small pocket of business activity that was happening at, say, an oil and gas company. It was really about what was happening within the core material part of the business plan. And as an investor that's grappling with a big challenge, which is the same as you, Joanna, we work on a net zero asset owner alliance, where we're thinking about what does a 1.5 degree portfolio actually look like? Well, currently as it is today, either we put everything into a small bucket of deep green assets. But actually, if we wanted to meet other challenges such as risk-adjusted returns or solvency, then we need to think about the bulk of the assets out there. And for us, then the question is, how do we bring what is today the real-world economy, the one that we built after the Second World War, which has brought us a lot of prosperity, but a large environmental footprint, to also come on the journey with us over the next 20 to 30 years, hopefully sooner than 2050, to achieve net zero. And it's really about that intentionality that we're asking for. So as an investor, first and foremost, we're looking from the corporate at the senior level to have that strategic intent. And so the findings have actually been extremely reassuring for me, because it's showing that across both the equity and the bond side of the market, across different sectors, there is actually a global recognition that there's really only one goal that we need to be transitioning towards, and that's net zero by 2050. And that is starting to come clearer and clearer. Now, within different regions and different sectors, it is going to be portrayed in different ways. And we have to give them almost a chance to work through that. But part of this is actually about partnering industry in this very difficult transformation to a low carbon economy. And from these points of view, I think I've really appreciated the level of involvement from the working group participants, and actually to the extent to which we're really largely heading in the same direction.
Very good, thank you. And Farna, maybe back to you. So does that finding now mean it doesn't really matter where you start, but if you talk about transition finance and if you're able to communicate that strategy given to, according to the guidance that will come out, net zero 2050 has to be the target, this needs to be shown, but then the market really is willing to come to the table and have that discussion.
Yeah, I think that's absolutely correct. I think that the detail around how you plan to get there is really important, and with regards to demonstrating governance and having a long-term target. As noted, I think there is also an appetite for seeing some degree of positive performance already. So we did see that greenhouse gas emissions that were reported on an annual basis and demonstrating kind of positive decarbonization trajectory. There was a lot of support for that being something that should be disclosed as well. But the most, nearly 90% of people who responded to the framework, to the consultation, responded saying that the disclosure on, what is your decarbonization strategy and what are the levers that you're going to use to get there, that strategic planning is something that I think, is unanimous among all stakeholders, that it needs to be part of the disclosure around any climate transition finance instrument.
Yeah, and that is really, really helpful. I see questions coming in, and maybe I'd like to ask Paul. I said in the beginning, the working group was on purpose set up to be instrument neutral, but really focus on the topic and what additional guidance was needed. The green and social bond principles traditionally come from a use of proceeds way, but we've just heard in the previous panel that now we have a new family member, which is sustainability linked bonds. We've heard the panel talk about some of the examples which could be tied to climate change. And I see questions twofold, one asking whether the SLBs are now putting an end to the idea of transition bonds on one hand, and on the other hand, a question on whether issuers from hard to abate sectors, if they wanted to go for green and transition bonds, kind of need to have underlying SPVs to kind of separate the green business to be able to issue. So I see there's a question of target link, there's a question of use of proceeds. Could the transition topic fit into both instruments?
I mean, yes, I think so. I think we have the flexibility there. So it's really up to the issuer to make the case to the investor, and all of these things ultimately will be I think a case-specific dialogue between the issuer and the investor. So if you have an SPV, you can, in theory, link a transition bond to that story if your SPV is set up to help you deliver transition projects. I see absolutely no reason why you couldn't build a transition bond concept around that. So I don't think there's necessarily any concept of, competing or, one type of structure sort of overshadowing the other. I think, there's room for all of these. And I think it gives issuers a lot of flexibility to decide how they want to approach the market, and that is, I think, what we're trying to deliver here. So I don't think that there's any question of supplanting one instrument with another. I think, you know, different issuers will find these different structures useful, but ultimately they're trying to communicate the same thing, which is, you know, we want our business model to be resilient. You know, we want to reassure the market. We want to assuage investors' concerns over some of these business models that are perceived to be, you know, part of the sort of climate change problem, in effect. And you know, I think there's a way for all issuers to use these instruments in the way that they see fit. Some may find it easy to use the sustainability linked bond because they happen to be, you know, in control of a stable data set, and they would find the general corporate purpose use of proceeds attractive. Some may find a traditional use of proceeds instrument attractive where they have significant capex, you know, directed at delivering these sort of low carbon transitions. And I'm thinking particularly in capex intensive sectors like steel, cement, oil and gas. You know, I think both of the instruments are on the table. Both can be complementary. I don't see any reason, incidentally, why you couldn't do both at the same time. You know, you could have a use of proceeds instrument for people who like, you know, that transparency and that visibility over the expenditure, and we'll have that sort of level of reporting more generally. And, you know, why not also have a KPI linked structure to sort of respond to investors that like the issuer to be held to account and have a simple metric that they can use to track progress. So I see these things as complementary and not necessarily in competition with each other.
Wow, that sounds like we have quite a bit of flexibility right now. So there are two important questions. Maybe one left is, I mean, given that we now have more clarity about the direction of travel, a big concern was still greenwashing. How should that be addressed? And maybe you, that's for you.
This is going to be the big challenge, I think, for everything we're doing within the environmental space, and especially when it's forward-looking. That's the key point here, is that as an investor, what we care about increasingly isn't what happened in the past. We want to know about where the issuing entity is headed for in the future. So there are things that we can ask for. It could be not just the long-term end goal, but obviously the interim targets. So the short and medium targets, which we could assess the company by. For me, it's important both on the equity side or the bond side to look at the transparency of expenditure that's been done at the board and senior management level. I want to see how actually financing is used to achieve the corporate strategy. And one of the great successes of the green bond market over time has been lifting the veil of opaqueness from the fixed income market and providing far more information than we've ever had the opportunity to enjoy. And that's something that I really believe is going to be a kind of strength and a pillar of the climate transition financing market. From my perspective, the guidelines which we are currently working on will provide a common language for any type of financial market transaction. Of course, we've started with the use of proceeds fixed income market as the starting place, but it's, as you say, instrument agnostic. It could be used in, you know, CLOs, equity, secondary equity, various different types of fixed income. There's no reason why it couldn't be utilized in that way, except that for the investor such as me, every time there is this type of language being used, we know that we will get certain types of information and forward-looking commitments for which we can then challenge senior management in our one-to-one meetings to understand essentially the way we do active management already, to really get to the nitty-gritty of whether we assess they're telling the truth or not. I mean, you know, that's how investment analysis ultimately works.
Yeah, absolutely. So to respect everyone's time on this call, maybe just one last question to Farnam. Jo has just started to tell us there will be guidelines. Why don't you tell us a little bit what you're planning and what we can see as next steps? And, you know, having invited a lot of industry knowledge into the working group, and you also mentioned the taxonomy, right? That space, both what transition means in terms of net zero, but also how reporting around it should happen, is increasingly regulated. So how does the working group fit in, and what can we expect to see next as a deliverable?
Sure. So as Yo mentioned, we are currently putting together kind of guidelines based on the responses to the 2 consultations and also our in-person meeting. And they are really very much going to cover the question of what are these kinds of expenditures that can be labeled as climate transition finance. And then also, what do you need at the issuer level in order to be a credible issuer, regardless of instrument and type of instrument. We were quite specific within the consultation in terms of asking, what should be the requirements, what should be identified as best practice, and we tried to a large extent to build off of the existing disclosure frameworks and guidelines that are out there and benchmarks that are out there, so that we weren't replicating, all the really good work that has been done, but rather sort of clarifying expectations of issuers. So that guidance note will now go through a period of working with the working group and responses from all of our experts, and we hope to have it finalized for later on this year.
Excellent. And then, of course, as usual, the GBP SPP work year-round, so whenever they will be published, and we will let you know. Thank you very much to the entire panel, Farnham, Yo, and Paul, for participating. And with that, and only 2 minutes of delay, I will be handing back to Nicola.
Joanna, thank you so much, and thank you very much to the panel. I just wanted to confirm a few things. One, there will be a recording of this event made available online. We will also slides. There's quite a few questions which our panelists weren't able to answer. Please be aware that we have in our working groups Q&A processes, so we will make sure to circle those questions to the working group so that can be integrated in their work. If you have urgent questions, you can always send them to greenbonds@icmagroup.org, and we will try to prioritize those. Now, to conclude, we hope you found the event instructive and that you'll be able to use to good and productive effect in the sustainable finance market the guidance and the best practice that you heard today from the GBP SPB, and that is being provided with the support of ICMA. We'd like to thank again our sponsor, the Luxembourg Stock Exchange. We wish you very well. And with that, goodbye.